An increased national budget, more Q2 earnings, both good and bad, and a new bill in America that could derail our BPO industry. It's time for another week, another opportunity. Welcome to Intelligent Investing. I'm April Tan, Chief Equity Strategist of Seoul Financial. The Philippine Stock Exchange Index slipped 0.4% to 6,315.93 last week as sideways trading continued. Interestingly, foreign investors were net buyers by about 1.2 billion pesos, but this wasn't enough to lift sentiment since losers outnumbered gainers 131 to 94. Their cautious tone was driven by U.S. inflation concerns, which could lead to less Fed rate cuts. The July Producer Price Index rose 0.9% month-on-month and 3.3% year-on-year. This suggested companies are passing on higher tariffs to consumers, reinforcing the Fed's wait-and-see stance, dampening hopes for a September rate cut.
If you were the U.S. Fed chair, would you cut rates in September?
I am with the more dovish Fed governors because it's quite clear that the jobs market is very difficult already in the US. It could be a one-time thing that the prices will go up because of the higher tariffs. But if the consumers don't have jobs, then how can it remain high? The thing is, the only time that it will continue to be going up is if the consumers accept that it is just what it is and we have no choice but to pay and we have money to spend. We can ask for a pay increase from our employers. But if their employers are losing money, they're not going to give them a pay increase. So they have to make do with whatever salary they have and just cut back on other things that are not essential. So it will not be inflationary in that respect. Here at home, things aren't looking so good. Out of the companies that we monitor, 35% of those that have released their 2Q profits so far missed expectations, and only 26% beat expectations. Median earnings growth also slowed further to 5% from 6.4% in Q1, which signals softening momentum. Looking forward, the government is planning to increase the 2026 national budget to 6.8 trillion pesos. That's 7.4% bigger than this year's budget and equivalent to about 22% of GDP. Although higher, the increase in the budget is slower than the 9 to 10% growth registered the past 2 years. The slower pace of expansion highlights the government's limited fiscal space, especially with the debt-to-GDP ratio climbing higher to 63.1%. This does not bode well for economic growth, given that the threshold for emerging markets is 60%.
As a Filipino, are you worried about the future of the Philippines economy with these stats?
At this point, not yet. I'm not yet worried about it because I think the government can still do something about it. I mean, we're still close to the 60% level. So maybe a little bit of short-term pain, a little bit of cost cutting should enable them to bring it down. For the 2026 budget, what I just like to highlight is that it looks like the government is more efficient this time around because even though it's increasing by only 7.4%, what I'm glad to see is now they're finally spending more on education. So the budget for education is higher by 15 to 16%, which is at least, very good. They're spending more also on social services. I think that's still increasing. And on healthcare, I think that one will also get a bigger share of the budget. So in other words, they're spending the money where it matters most rather than spend it on things that are supposed to deliver benefits but are not. Like right now, the controversial flood control projects, diba? So at least, let's see. If they really succeed in, I guess, revamping the agriculture sector and making rice permanently cheaper and vegetables and fruits, then, that should control inflation, which is good for the economy on a longer term. Now, let's dive into a number of industries' corporate earnings and what they mean. CNPF's 2Q profits increased by only 4.3% to 2 billion pesos as the company suffered from weaker OEM exports of tuna and higher input costs. Although CNPF offset the drop in gross margins with cost-cutting measures, management decreased their profit growth estimates from 10 to 15% to just high single-digit to low double-digit percentages. Because of this, shares of CNPF fell 5.6% last week. DNL's 2Q profits increased by only 2.4% to 714 million pesos as high coconut oil prices hurt the margins of its food ingredients business and pushed up financing costs as its working capital requirement increased. Despite that, DNL shares went up 3.1% thanks to the strong performance of its other subsidiaries. JFC saw core 2Q profits increase by 2.4%. Although revenues jumped by 15.5%, gross profit margin contracted due to higher than expected inventory costs, offset by a drop in operating to sales ratio. With that, JFC's share price went up 2.82%. I think with the higher input cost, the problem is the confidence isn't there. If I'm an investor, I don't know if the next few quarters the company will continue to suffer from the same problem. So the sustainability of the growth that I'm seeing might not be there. Like DNL using a lot of coconut oil, and I still see coconut oil prices going up in the global market. So that could mean that third quarter earnings might still not be good. So I think that's what's worrisome. Things aren't looking good on the telco side either, as PLDT and Converge delivered disappointing 2Q profits, just like Globe 2 weeks ago. Tel's 2Q profits fell 2.9% to 8.4 billion pesos from poor mobile phone business performance and higher interest expenses. On the bright side, earnings contribution of its fintech business Maya grew 66.4% quarter-on-quarter due to the strong growth of deposits and loans and an improvement in net interest margins. Meanwhile, Converge saw 2Q profits grow by 6.8% to 2.9 billion pesos, but earnings were still weaker than expected due to the drop in average revenue per user. This resulted from the growing share of prepaid subscribers. The telco's costs increased as well to support its growing subscriber base. Because of this, management lowered its revenue and EBITDA forecast. This, along with the disappointing 2Q profits, caused shares to drop 16.6%. Note that Converge has been one of the best performing stocks since 2024, which may explain why there was room for the stock to drop as sharply as it did. I think we highlighted it during the first quarter that one of our issues is that the third telco is already gaining momentum, si Dito. That could still be one of the issues that would limit their ability to grow mobile. And mobile is still a large part of their earnings. The reason why Converge share price went up sharply last year was the success of its prepaid broadband business. Further rolling out that business is becoming more difficult. Like, they need more people. There's a shortage of technicians. So maybe that's why it's more expensive now to hire technicians. And maybe if you have to service so many prepaid subscribers that are generating lower average revenues, then the cost went up. The margins are not going to be as good as postpaid. GTCAP's 2Q profits jumped 38.6% to 9.4 billion pesos, driven by Toyota Motor Philippines' higher auto sales and improving margins resulting from the stronger peso and a favorable model mix. GTCAP shares jumped 7.2% last week. However, its impressive earnings growth might slow down soon as the peso and car sales are stabilizing. This could pull down Toyota's future profit growth. MPI also delivered a strong performance due to its investments from Maynilad, Meralco, and MPTC. JGS 2Q core income rose 43% to 7.2 billion pesos, driven by Cebu Pacific's profits more than tripling and the lower losses of JGSOC, which decided to stop operating its factories. Because of this, shares of JGS jumped 7.8% last week. Plus, 2Q25 net profit climbed 30% to 4.2 billion pesos, driven by a 31% jump in revenues. And even if it was recently added to the PSEi index, regulation risks remain at large. Last Thursday, the BSP ordered all e-wallets and banks to remove in-app gambling assets and links that direct users to gambling. The use of credit cards to pay for online bets will also be prohibited. This suspension will stay in place until guidelines for online gambling payment services are finalized. Because of this, share price stayed the same despite its strong profits and its addition to the PSEi index. Lastly, Bloom reported a recurring net loss of 1.3 billion pesos in 2Q25 due to the poor performance of Soler Entertainment City, as well as expenses for its online gambling platform Mega Fanalo. Shares of Bloom fell by 3.7% last week, adding insult to injury after being removed from the PSEi index. MREIT approved a capital stock hike to 8 billion pesos, paving the way for major asset infusion from Megaworld. This could accelerate its goal of reaching 1 million square meters of gross leasable area by 2027, 3 years ahead of target. On the risk side, U.S. senators filed a bill discouraging the outsourcing of call centers called Keep Call Centers in America Act of 2025. If passed, this could hurt the Philippine office leasing sector, which is heavily exposed to the IT BPM industry. Among listed property companies, Philinvest Land has the largest exposure to office leasing, with approximately 20% of revenues derived from this segment. Robinsons Land and Megaworld follow closely at 18% each, while Ayala Land has about 9%. The potential impact is even more significant in REITs, where office assets comprise the bulk of most companies' portfolios. DDMPR is fully exposed, while PhilREIT, MREIT, AREIT, and RCR are also highly exposed. In the near term, this uncertainty may dampen investor sentiment towards property companies and REITs with high office exposure. The keep call centers in America is because of worries by the Trump administration of losing jobs because of AI. So they're already losing jobs to outsourcing, and then they'll lose more pa because of AI. So they're thinking of punishing companies. They will not be qualified for federal grants, loans, and they will not be prioritized in the awarding of contracts. For us, the impact, remember, if we talk about the Philippines, like, economists will always highlight how, we're getting so much revenues. As of last year, I think we generated $38 billion. The IT BPM industry provided 1.8 million jobs to Filipinos. It's a bit worrisome, or something that we should, closely monitor. So to sum up, the market remains range-bound amid U.S. inflation worries. Fiscal support is there, but not as aggressive as before. And at the stock level, earnings are a mixed bag. If you found this helpful, don't forget to like, subscribe, and hit that bell icon to be the first to know what's moving the market. Another week is another opportunity. I'm April Tan, and this is Intelligent Investing. See you again next week.